This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Thank you for joining us. I'm Gord Long. I have with me this morning John Rubino, well-known writer, author, and probably better known for his website, dollarcollapse.com. Welcome back, John.
Hey, Gord. Good to talk to you again.
I've been looking forward to talking to you, well, as usual, but I really wanted to talk about Deutsche Bank and what's going on in Europe. And we've been talking about the whole European banking system for some time, and it looks like it's beginning to come to a head right now. And and as you know, John, we were talking earlier, I wrote a very large major article over at triggersmatasii.com on Deutsche Bank back in the spring, where I felt it was a major short opportunity. And in spite of the stock coming from $138 back 2002 and then dropping down, the big money now is, they're trading 12.5 today. We went in another second round of shorting at 14. We see the stock going to $6. This is not an investment advice. Just the point is that we've been on this for quite some time, and it looks like it's coming to fruition. There will be some very violent counter rallies in here based on what Merkel does, but this is where the money's made, actually. And because from, let's say, $12 today to $6, if we happen to be right on this, our estimate, that's a double. Whereas from 138 down, it took you 5 years to kind of get that when it got down to $60, $50. So this is where the money's made, but it's also where the risk is, right? Because it can go the other way if they bail them out and everything else. I have up here the agenda, the things I wanted to cover today. So what's your views on what's going on with Deutsche Bank? Because there's a lot of confusion.
Well, my view is that now we can stop watching the Italian banks, which we thought were going to blow up first, and start watching the German banks, because counterintuitively, the most rock-solid banks, in theory, in the most rock-solid country in Europe have now become the big systemic risks in the global economy. And part of the reason for that is that the German banks have been doing something called vendor financing, in effect. They've been lending money that they could borrow really cheaply to the rest of Europe. So they're on the hook for Italy and Spain and Greece and Portugal, which means that the peripheral countries in Europe, which can't function in the Eurozone as it's currently configured, are a big risk for Deutsche Bank. If they can't pay, then Deutsche Bank is on the hook for all of that money. And it's turning out that it's looking less and less likely that they're going to be able to pay back the big German banks. And so that's why the German bank stocks have been falling year after year and week after week, because people are figuring this out, that these big solid banks that everybody thought were the pillars of the European economy are actually the centers of the risk in the European economy, because they own all this debt that's going to blow up. And they've played a lot of games with derivatives, in part to hedge a lot of this debt that they've been taking on, and in part, I think, just to generate fees so they can have higher year-end bonuses for their executives. And so the Deutsche Bank, for instance, has a derivatives book that dwarfs the German economy and also dwarfs the entire continental economy. Their derivatives book is bigger than the Eurozone economy. So let a tiny fraction of their derivatives go bad, and the amount of money that they will lose will be gargantuan in terms of their own balance sheet and the balance sheets of the countries in which they operate. So Deutsche Bank, as you said, is bigger than Lehman Brothers, for instance. That's the investment bank that blew up, was allowed to fail, and set off the contagion that became the 2008-2009 financial crisis. Well, Deutsche Bank is a much bigger problem than that, because relative to the size of the economies in which they operate, they are a much bigger deal. So let them blow up, and the whole European project is in danger of unraveling. Meanwhile, you got Commerzbank, which isn't as big as Deutsche Bank, but is still a huge global bank, laying off, 10% of its workforce. They just announced they're going to take massive write-downs. They're going to scale back a lot of business lines because they're not working either. They're not functioning and they're not profitable in their currently configured state. And so they've got to scale back to avoid total collapse. And so all of a sudden, these peripheral countries that we thought were going to be the epicenter of the crisis are kind of a sideshow because Germany is now the big deal. If Germany tries to bail out its major banks, then what they'll do is shift the focus from a banking crisis to a currency crisis. In other words, they will impair the euro. So we could end up with a major currency crisis, starting in Europe and then spreading to the yen and the dollar and the yuan, as everybody else has to respond in kind if the euro gets dramatically devalued. So this is a very big deal, and it looks like it's coming to a head. If you look at the price chart that you got behind you of Deutsche Bank, how much further down can it go before it becomes a crisis? Can it go from 30 at the beginning of this year to 6? Which it looks like it's heading for, without it turning into some kind of an international crisis and focusing everybody's attention on it and getting all the traders of the world thinking, okay, what's next? If Deutsche Bank goes, what do we need to be shorting now and selling now in order to protect ourselves from Deutsche Bank's collapse? And the answer to that question will be everything. You don't want to be in any big bank stock if Deutsche Bank blows up. You certainly don't want to be in the Italian banks, but also not Citigroup, JP Morgan Chase, Wells Fargo, Goldman Sachs. All of these guys will take a hit. And it might be systemically destabilizing, which means everything else takes a hit. So this is a big deal. And it looks like 2017 is the year in which this gets resolved one way or another. Either it blows up and collapses, or it gets bailed out, and then the euro collapses, or some other related thing happens. But it seems to be imminent as well as inevitable now. So we'll have this to talk about for the next 6 months, probably, Gord.
What do you think Merkel will do or can do? Because she is certainly confusing everybody right now.
Angela Merkel looks like she's towards the end of her run as German chancellor because, leaving Deutsche Bank out of the equation, just the immigration thing would probably lead to regime change in Germany in the year ahead. But you throw a major banking crisis into the mix, and, it's hard to see how she gets out of this with her political life because there's no pain-free way out of a banking crisis when you are as dependent on your two big banks as Germany is. The U.S., we had a banking crisis, and it was nightmarish for a couple of years. But we had a lot of big banks, and then we had a lot of other banks. Well, Germany's not like that. They've got these two big banks, and then they've got a few smaller banks, but not that many. And so Deutsche Bank and Commerzbank blowing up is a much bigger deal in percentage terms relative to the size of the economy. So she can't get out of it painlessly. If she lets them collapse, the German economy goes into depression, very possibly, and takes Europe with it. And if she bails them out using taxpayer money, that shifts the focus to the euro. In other words, if Germany impairs its balance sheet to the extent that would be necessary to bail out these gigantic banks, and the euro depends on the strength of the German economy, then what does that say about the euro? It says the euro is not nearly the rock-solid reserve currency that they would like us to think it is. And so it'll get sold in the foreign exchange markets. The euro will plunge. And, that'll cause turmoil within the Eurozone, but it also causes turmoil in the rest of the world. All their trading partners will suddenly see a deterioration in their terms of trade. In other words, Europeans selling stuff to the U.S. will be able to cut their prices dramatically because they're pricing their stuff in a cheaper currency. Well, that hurts our companies in the U.S. Corporate profits will go down. And since equity prices, U.S. stock markets depend on the underlying value of the companies that issue stock for the S&P 500, let's say, and stock values depend on the underlying earnings of these companies. And if their earnings go down, that means prices should go down. And so we'll see very possibly an equities bear market, which we probably can't handle. You give us a 20% drop in the overall stock market in the US. And that's kind of a garden variety bear market. Happens every 7-8 years normally. And you get through it when you're a reasonably healthy economy. Well, we're not a healthy economy anymore. We're grossly over leveraged. So give us a bear market in equities, and we really don't know what would happen. That's why the Federal Reserve is so focused on the stock market right now. They won't raise interest rates if the stock market's going down. And the reason for that is they're terrified of turning a correction into a bear market, which then metastasizes into a Great Depression kind of collapse. So a Eurozone crisis could set off that kind of a series of dominoes falling in the US. And, everybody who's making policy knows that. They're all terrified of any kind of a disruption in what is really an extremely placid market right now because of government manipulation. So, long answer to what could be a very short crisis in terms of the major events. Deutsche Bank collapses. Germany is faced with the question of whether to bail them out or not, chooses to bail them out. The euro then collapses, which sends the U.S. stock market into crisis, which sends the U.S. economy into crisis. That could all happen in 2017 because each of those things is basically a one-decision crisis. The government decides to do something, the markets react to it, and there you are. So 2017 could be an incredibly eventful year, and probably a target-rich environment for short sellers, like you were saying just now. The big banks of the world have gone down quite a bit over the last couple of years, but we haven't had capitulation yet. We haven't had that waterfall decline where they go straight down by 80% from wherever they started on a given day. And that's the kind of thing that we could see if this scenario that I'm sketching out takes place as I sketch it out. So, could be a lot of fun if you're short these things. Could be a nightmare if you're long a general traditional equity portfolio and a bond portfolio, because who knows what happens to the bond markets if we tip over into currency crisis, because who wants to own government bonds when the currency war is heating up and everybody's trying to devalue their currencies? So I don't know. It should be fun for people who think like you and me, Gord. It should be a nightmare for almost everybody else.
It's still difficult because even if you're on the short side of it, these counter rallies are violent because they're driven with political decisions. But it's like a perfect storm shaping up here, John. We could spend a whole discussion here on what's going on in China, the seriousness there. We could talk about Japan. We could talk about the U.S. going into recession. So we could talk about the fallouts from the current political presidential campaign. There are so many flashpoints right now. The Deutsche Bank, being one of the largest banks in the world, it's absolutely the wrong time for this to appear. And the article that I mentioned earlier that I had written, that I was worried about 5 months ago, said that, and I called it Deutsche Bank equals Lehman plus Bear Stearns plus Enron squared. And that is, and as you point out, Lehman Brothers 28 to 1 failed. Deutsche Bank's 55 to 1, officially I think 38 to 1. Enron collapsed on derivatives and their structure. You just mentioned the magnitude of the derivative structures at Enron. And I think they're even larger than we really believe, and who knows, never mind Commerce Bank. And Bear Stearns collapsed on bonds and the problem it had and Deutsche Bank's the holder of the Portuguese, the Italian, the Spanish, the Greek, the bonds. So I don't know the way out. I don't know if there's a solution. I can't talk about the time frame, but certainly after the election, hold on to your hat. It will be a very, very interesting time. And John, going to the next point on our chart was, we're seeing surprisingly food prices starting to fall. And to me, that's another flashpoint here.
Yeah, a lot of people feel accelerating inflation in their own lives because they're paying college tuition, care costs are going through the roof. But there are other signs that the system is going the other way, and one of them is food costs. In the US, grocery store prices have fallen for 9 straight months, and the decline is accelerating. Now, that could be an anomaly, or it could be the canary in the coal mine, the thing that implies that ultra easy money, ultra aggressive fiscal policy hasn't worked. It hasn't given us the rip-roaring inflationary boom that Keynesian economics says you should get from negative interest rates and trillion-dollar-a-year government deficits. So if it hasn't worked yet, and we're starting to see growing pockets of the economy roll over into deflation, which, by the way, is the case in other countries too. Japan's inflation rate is pretty much zero. Most of Europe is seeing zero to just slightly positive inflation. And in some cases, some countries are tipping over into deflation. If that becomes a general trend, then that's catastrophic for an over-leveraged society. When you owe huge amounts of money, you want inflation. In other words, you want the currency to go down in value so you can pay off your debts in cheaper currency. That makes it easy, and that's what the world's policymakers want. They want 2% inflation officially, but they would love 4% inflation because that would cut the real value of all of their debts. Well, what they're getting is 0.1% inflation around the world, if even. And if food prices are any kind of an indication, we might see even less than that and maybe deflation going forward. That's a catastrophe for these over-leveraged countries. That'll blow up the banking system if it doesn't blow up before. And that will also blow up government balance sheets because they're still taking on huge amounts of debt and their potential interest costs are going through the roof. In other words, if you're borrowing huge amounts of money at negative 1%, that's actually a profit-making enterprise for you if you're the Swiss National Bank, Swiss Central Bank, or the Bank of Japan, or the Bundesbank. But that also means you can never raise interest rates to normal levels because you're taking on so much debt now at these cheap levels that when you have to roll it over at higher and higher rates, your interest costs go through the roof and your budget blows up. So we're building that into the system. And if they have to borrow even more to counter deflation, that builds an even bigger crisis into the cake, in the future when they try to raise interest rates to normal levels. So we're creating conditions in which we're in a trap where we can never get out. So either things blow up now, which it looks like they might, so a lot of the speculation might be academic because we never get to that point. But if the system doesn't blow up now, then we're in a situation where we're stuck with incredibly low interest rates, which distort the price signaling mechanism in capitalism. So we're stuck with dysfunctional markets for as far as the eye can see. And so the system never works, and it continues to leverage itself until it really blows up. So it's a blow up now, or an even bigger blow up in the future. Which, by the way, Gord, is something you and I've been talking about for the entire 5 years that we've been doing these podcasts, because that's always been the case for the past 30 years. We could have a crisis now, or we could have a bigger crisis in the future. And we have managed to push the ultimate crisis off into the future for such a long time now that a lot of people are starting to conclude that maybe we don't ever have to have a crisis. And that's wrong. We've just got some new age monetary tools that have allowed us to delay the inevitable at a cost, at a cost of an even bigger crisis out there in the future. And so we're living in that future. If Deutsche Bank blows up now, that is a crisis that will dwarf the 2008-2009 crisis. If it doesn't blow up now and is bailed out, then 2017, 2018, 2019 has the potential for something even worse. So, we're talking about the end of this system when it goes now. That is fractional reserve banking failing catastrophically and being replaced by something else, fiat currencies failing catastrophically and being replaced by some form of sound money or some really cool and uses price controls and capital controls and other methods of coercion to impose their will. One or the other, that's what we're going to get. And it does feel like it's coming. It's not some 10 years out kind of issue. It feels like it's going to happen in the next few years. So, and I would have said that in 2008, 2009. We got past that. But this is much bigger and much scarier. And when it comes, it's going to be that much harder to deal with.
Well, we were talking in 2008, 2009, we called extend and pretend, kicked a can down the road, and we debated how long they could do it. And here we are in 2016. Never underestimate what governments and central banks will do under pressure. And I think there's a lot more that's going to shock us. I heard Yellen saying, yeah, there's a chance we would buy stocks in the U.S. stock market, but then saying that's down the road maybe if there was problems. Those are straw mans that are being put up, straw balloons that are being put up. There's so much more to go that it could go on for another 2, 3, any number of years, but something will come out of nowhere when we least expect it. Because the system is now, in my opinion, unstable, and but you can't time this. I don't think it's possible to time it.
The short side of the market has become the interesting side, and I think precious metals have become the interesting asset, because those are things that react well in times of crisis. And it really does feel like some kind of a crisis is coming, just because so many could happen. And when they happen, they could spread in so many different directions. So, it's Deutsche Bank this week that we're talking about. Maybe next time around, it'll be the Italian banks again, or it'll be something happening in Japan, or it'll be the U.S. stock market tanking because the Fed finally got up the courage to raise interest rates. It could be anything. The point is, when it happens, does it spread? And I think there's a good chance that the answer will be yes. Something's going to happen. It'll cause that avalanche that wipes out the village at the base of the mountain, and that village is your money. So it's time to get very, very conservative with our finances and take the crisis investing side of the bet whenever possible.
That's the whole we've come out at the Financial Repression Authority, John, and we've studied this extensively here for a few years now. And our view is you don't want your assets in the banking system today. This is not a negative so much as just prudence. You want to be you want to be out of the financial instrument marketplace. You may make a lot of money, you may lose a fortune, but it's the risk reward in here is out of balance. There's times not to be in it, because there are so many better places that you can put money that delivers discounted free cash flows that aren't dependent on security tradings. And I haven't said that in all the years I've been in it, but there's a time to act. There's a time not to be in the game of trading, even though there could be a lot of money on it, because there's other returns, and they're there, but it's a different way of thinking. And if you've got your assets in place, because the world is not coming to an end, there's going to be some incredible opportunities in the not too distant future. But we'll see on that. John, we have to wrap. Any last comments you'd like to make?
No, Gord, I think we've covered it well today.
You've been doing podcasts. I strongly recommend our listeners have a listen to them. You put them out weekly, right, John?
In theory. This week's is a little late, but it will be out in a couple of days.
By all means, they're on John's site, and he touches on a lot of these subjects on a more current basis. We only do these once a month to stay current on these discussions. John, and you have a newsletter that sends out all of your writings, or reports you put out?
Yeah, you can sign up for that mailing list on dollarcollapse.com.
Talk to you again next month.
Great. Thanks, Gordon.
Thanks, John.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.